Hi, I'm Steve Bigger, Director of Equity Research for S&P Capital IQ. Welcome to this week's edition of Equity Analyst Forum. With me today on Equity Analyst Forum is Eric Hugel, Aerospace and Defense Analyst for S&P Capital IQ. Eric, welcome to the program.
Thank you. Glad to be here.
So this week's focus stock of the week is Textron. Can you tell us a bit about the company?
Sure. Textron is an industrial conglomerate, about $8.5 billion market cap, a little over $12 billion in sales. They play primarily in the aerospace and defense industry. About 75% of their sales are in the industry. Mm-hmm. They own two of the premier iconic names in the industry, namely Bell Helicopters, which manufactures helicopters, both the commercial and military markets for U.S. and our allies. Mm-hmm. They own Cessna also, which is a manufacturer of general aviation aircraft, mm-hmm. The Citation business jet brand, as well as the Caravan and Grand Caravan turboprops, and a number of single-engine piston aircraft. They also manufacture unmanned aerial vehicles, combat vehicles, and smart weapons and sensors that we sell to the U.S. military and our allies. Mm-hmm. In terms of the industrial business, they own a number of companies across a variety of industries. Kautex, which manufactures equipment that goes into the automotive market for fuel systems. Mm-hmm. EasyGo, which manufactures golf carts and other light transportation vehicles. Greenlee, which makes equipment that goes into construction for installation of cable and electronic wiring, mm-hmm. As well as Jacobson, which makes turf care equipment for golf courses, as well as sports arenas and municipalities. Mm-hmm. And they have a small finance business, which is used primarily to finance equipment purchases from the other divisions. Mm-hmm. In terms of why invest in Textron today, we see Textron as a long-term, strong growth business. Over the last couple of quarters, though, the business has hit some headwinds. We believe that they're largely transitory in nature, mm-hmm. and namely at Bell, they had an ERP system implementation issues that they've been dealing with since the beginning of the year, and then in the third quarter they had a labor disruption around a union contract, mm-hmm. That added some cost to some of the products, as management had to fill in for some of the roles that they're trying to work that out now. The contract has been renewed, so those issues are sort of behind us. At Cessna, the issues have really revolved around issues with the weak market, mm-hmm. for the small and medium-sized business aircraft, as well as management's. At the beginning of the year, management made a decision not to aggressively cut prices on their aircraft in order to spur sales. Mm-hmm. We see that has some negative near-term implications, but long-term we see that as a positive. And then they're dealing with some their new development cycle for aircraft. They're in the process right now of developing 5 new business jet aircraft, mm-hmm. 3 of which are set to deliver in the next couple of months. Mm-hmm. So the costs involved with that, and they had some delays with regards to that in the second quarter. Mm-hmm. Really, if you look at Textron over the last 3 to 5 year period, it's traded in line, multiple in line with its industry peer group. But because of these issues over the last couple of quarters, the stock started to trade at a pretty substantial discount to the group. And we see that there are catalysts on the horizon that will drive that trading multiple back in line into parity with the group. Mm-hmm. Namely, at Cessna, that's the primary catalyst. For right now, if you look at Cessna's earnings and sales, they're pretty depressed, because if you think about where we are in the company's business cycle, in terms of the market, we're at the bottom of the demand cycle, and in terms of new product development, we're at the top of that cycle. And over the next couple of months, as their new programs deliver, that we expect those cycle dynamics to start to reverse, and we could see a pretty healthy recovery in terms of sales and earnings. So the catalyst to look out for is the M2 jet and the Sovereign jet, which is set to deliver in Q4 over the next couple of weeks, and the Citation 10 jet, which is set to deliver in the first quarter. So we think in terms of earnings for 2013, we're looking for $1.77. That's down 10% year over year on roughly flat earnings as we've suffered through some of these headwinds. But as we move into 2014, we see a significant rebound as we see some of the benefits of this turnaround. We're looking for earnings to increase about 30% up to $2.30.
So how about the valuation of the stock? What do you like there?
In terms of the valuation, right now the stock is trading at about 13.4 times our 2014 earnings estimate, about 13.6 times the S&P Capital IQ consensus. It's about a 10%, 11% discount to the S&P Aerospace and Defense Select Industry Group. It's a broad peer group of aerospace and defense stocks. Again, historically, if you look back over a trailing 3 to 5 year period, it's traded on par with that group. And we think that as the catalyst plays out, we think the ability to go back to those levels is certainly in the cards. Our $35 price target is simply putting the multiple of that S&P Aerospace group, which is currently at about 15.4 times, onto our $2.30 earnings estimate for Textron. And we see some further upside potential from those levels if, one, we see continued global economic recovery that would lift multiples across the group, or two, if we see a stronger than expected recovery in the group, in Textron.
So how about risks? What would you highlight there?
In terms of risks, I would say the major risk here is another a global economic recession, which would obviously have negative impacts with regards to Cessna and the industrial businesses. The other major risk is sort of their execution in terms of the catalysts that we're looking for, their ability to deliver those new jets on time, on budget. As well as some longer-term development programs, their Longitude and the Latitude aircraft, which are set to deliver in 2015 and 2017. The other major risk that we would look at is in terms of their defense business, a greater than anticipated hit in terms of defense spending with regards to the U.S. government fiscal budget constraints and sequestration. And I guess lastly, we would talk about the issues in terms of management resolving the issues that the Bell system has been suffering through over the last couple of quarters, namely the ERP system, and working their way through on a timely and efficient basis through some of the cost issues with regards to production.
Great. Thanks, Eric.
Thank you.
And that's been this week's edition of Equity Analyst Forum. We'll see you again next week.